Welcome to the deep dive. Today, we're going to be diving into Secrets of Millionaire Investors by Adam Koo and Conrad Alvin Lim. You've handed us a mix of their personal stories and some pretty interesting investment strategies. Our mission today is to try and equip you with all the core concepts you need to understand how wealth is built through stock market investing.
And what's great is that this book doesn't just tell you what to do, but it shows you how these principles have played out in real life.
Exactly. So let's start with Adam Koo. His story is all about the power of starting early. Who gets stock certificates as a birthday gift from their grandpa?
Yeah, it's a brilliant lesson in planting that seed of financial literacy early on. But what's interesting is even with that head start, Adam didn't become a millionaire overnight. He actually took some initial losses in the market.
And that's a point that the authors really drive home. Just relying on someone else's advice without understanding the fundamentals yourself can really backfire. It's like trying to drive a car without knowing the rules of the road. You might end up in a ditch.
Exactly. Now contrast that with Conrad Alvin Lim's journey. He went from bankruptcy to achieving some seriously impressive returns, averaging 19.9% per month.
Whoa, hold on. 19.9% monthly returns. That's mind-blowing. What's the secret sauce? Did he win the lottery or something?
Well, not quite a lottery,
Okay.
but he developed this technique that he calls scalp, which involves making rapid trades based on very specific market indicators. He claims to be making an average of $1,200 profit every 12 minutes.
Okay, that's seriously impressive. But let's be real for a second. These guys are practically investment gurus. Can the average person really achieve those kinds of results?
That's actually one of the big myths that this book debunks. It emphasizes that anyone can start investing, even with small amounts. It's about understanding the power of compounding, essentially letting your money make more money for you over time.
Okay, so compound interest. I've heard that that's like the eighth wonder of the world or something, but how does it actually play out in the stock market?
Well, the book uses some compelling examples, like how $10,000 invested in the S&P 500 50 years ago would be worth over $1 million today, all thanks to the average annual return of 12.08% and the magic of compounding.
Wow, that's a pretty convincing argument for getting started sooner rather than later, but they mainly focus on the US markets, right? Why not stick to the Singapore market?
Well, think of the U.S. market as a massive buffet with all these diverse options. It offers a wider range of stocks, higher liquidity, meaning it's easier to buy and sell, and access to financial tools like options, which can amplify your returns, though also your risks. They do touch upon the Singapore market a little bit, but suggest the U.S. market is like a more dynamic playing field.
Got it. More choices, more action. But let's get down to brass tacks here. The book dives into several investment strategies, starting with what they call the idiot-proof way. That sounds promising for someone like me.
Yeah, the idiot-proof way is all about simplifying investing for the long haul. Instead of trying to pick individual stocks, they recommend buying the entire market through exchange-traded funds or ETFs, specifically ones like SPDRs that track the S&P 500.
So you're basically betting on the overall growth of the market rather than trying to outsmart everyone by picking individual winners.
Exactly. And they couple that with a technique called dollar cost averaging, where you invest a fixed amount at regular intervals regardless of market fluctuations.
That seems like a good way to take the emotion out of investing and avoid making impulsive decisions based on fear or greed.
Right, and the authors point out that historically, holding on to an S&P 500 ETF for a 5-year period practically eliminates the risk of losing money.
But what about those times when the market seems overpriced? Everyone's talking about a bubble, and you're worried about buying at the peak.
That's where the PE ratio comes in. They explain how this simple tool helps gauge market valuation, telling you whether the market is underpriced, fairly priced, or overpriced.
So basically a sanity check before you jump in. Now, they do mention CFDs as a way to potentially magnify returns, but they come with a warning label, right?
Oh, yeah. CFDs, or contracts for differences, allow you to leverage your investment, essentially amplifying both your gains and losses. So they're a tool for more experienced investors who understand the added risks.
Right, not for the faint of heart. So that's the idiot-proof way. Low risk, long-term, steady growth. But the book doesn't stop there. It goes on to explore more active strategies like value investing, momentum investing, and even options trading.
Let's dive into those next. Value investing, championed by Warren Buffett, is all about finding those hidden gems, the companies that the market is undervalued, buying them at a discount, and holding on to them for the long term.
So you're basically playing the role of a bargain hunter in the stock market, looking for those diamonds in the rough.
And to help you find those diamonds, they outline 9 key criteria to look for in a value stock. But instead of overwhelming you with all 9, let's focus on one that stands out. identifying companies with a sustainable competitive advantage, what Buffett calls an economic moat.
An economic moat. Sounds intriguing. Is this like a real moat filled with crocodiles protecting a castle?
Well, not literally crocodiles, but it refers to a company's unique strength that helps protect its profits from competitors. A great example from the book is Walmart.
Walmart. I wouldn't have thought of them as having a moat.
Well, their moat comes from their massive scale and efficient operations, allowing them to offer lower prices than their competitors, consistently attracting customers and generating profits.
Okay, so it's not just about finding a cheap stock. It's about understanding the underlying business and its ability to stay ahead of the competition. But how do you actually determine if a stock is truly undervalued?
That's where things get a bit more technical. They introduce the concept of calculating a stock's intrinsic value, which is basically what the business is truly worth based on its assets, earnings, and future growth potential. They even walk through a simplified example using Walmart's financials to illustrate the process.
So there's some number crunching involved, but the idea is if the market price is significantly lower than the intrinsic value, you might have found yourself a bargain.
Exactly. But value investing requires patience, because you're essentially waiting for the market to recognize the true worth of the company.
Speaking of patience, how does that compare to the next strategy, momentum investing? That sounds a bit more fast-paced.
Yeah, momentum investing is all about riding the wave of market trends, identifying stocks that are on the rise and poised for rapid growth, often driven by things like positive news flow, sector rotation, or analyst upgrades.
So you're basically trying to catch a rising star before it explodes into a supernova.
That's a good analogy. They provide 6 key screens or filters to help you identify potential momentum stocks, like looking for stocks that have recently broken through their 52-week high, or stocks in sectors that are currently outperforming the market.
So timing is everything with this strategy. Getting in early before the price skyrockets and knowing when to get out before the momentum fades.
Absolutely. And they emphasize the importance of using technical analysis, which involves studying charts and patterns to identify buy and sell signals, things like support and resistance levels, which indicate where the price might find a floor or a ceiling.
So it's kind of like reading the market's body language, looking for clues about where the price is headed.
Exactly. But they also stress the importance of cutting your losses quickly with momentum stocks, because the trends can reverse just as quickly as they emerge. They advocate for setting a strict 10% stop-loss rule, meaning you automatically sell if the stock drops 10% below your purchase price.
So it's a high-reward, high-risk game, but with a safety net to limit your losses. Now, the final strategy they delve into is options trading. And I have to admit, this one always seemed a bit intimidating to me. Are we going to need a PhD in finance to understand this?
Don't worry, they break it down in a way that even a beginner can grasp the basics. Options are essentially contracts that give you the right, but not the obligation, to buy or sell a stock at a specific price within a specific time frame.
Okay, so it's like placing a bet on whether a stock will go up or down, but with more flexibility and leverage.
Exactly. They mainly focus on 2 types of options, calls and puts. A call option gives you the right to buy a stock at a specific price, and you profit if the stock price goes up. A put option gives you the right to sell a stock at a specific price, and you profit if the stock price goes down.
So you can potentially profit from both rising and falling markets. That's pretty cool.
They highlight the potential for 100–500% returns with options. But they also caution that losses can be magnified if the stock doesn't move in your favor.
So again, higher risk, higher reward. They also touch upon a strategy called straddles, which sounds a bit more complex.
Straddles involve buying both a call and a put option on the same stock with the same strike price and expiration date. This strategy is used when you expect a big price move, but you're not sure which direction it will go. For example, you might use a straddle before a company's earnings announcement, when the stock price could jump up or down significantly.
Okay, that's starting to get a bit over my head. But it sounds like options trading is a whole other level of investing, requiring more knowledge and experience.
They definitely recommend starting with the simpler strategies first, like the idiot-proof way or value investing, and then gradually exploring more advanced techniques like options as you gain confidence and experience.
Makes sense. But before we get ahead of ourselves, let's step back and talk about something they emphasize throughout the book: the psychology of successful investors. It can't just be about crunching numbers and reading charts, right?
Absolutely. They dedicate an entire chapter to the mental game of investing, outlining 7 key habits that are just as important as any strategy.
So what are some of these mind-blowing habits? I'm all ears.
Well, one of the most important habits they highlight is making decisions based on predefined rules, not emotions. It's easy to get swept up in the excitement of a bull market or panic when things start to go down.
Oh, I know that feeling. My heart definitely skips a beat when I see my portfolio in the red. It's tempting to just sell everything and hide under a rock.
Exactly. And that's what the average investor often does, leading to those classic mistakes of buying high and selling low. But successful investors operate differently. They have a plan, they stick to their rules, and they don't let their emotions drive their decisions.
So it's like having a set of traffic lights for your investments. Green means go, red means stop, and yellow means proceed with caution.
That's a great way to put it. They also emphasize the importance of embracing losses as part of the game. Every investor, even Warren Buffett, experiences losses from time to time. The key is to cut those losses short before they snowball into something bigger.
So it's about accepting that losses are inevitable, but knowing how to minimize the damage. Kind of like a surgeon who knows how to make a precise incision to minimize scarring.
Exactly. They also highlight the importance of investing only within your circle of competence, which means sticking to areas you understand and avoiding those hot tips from your uncle's friend's neighbor.
Oh yeah, everyone seems to have a hot stock tip these days, but it's like trying to perform brain surgery after watching a YouTube video. Probably not a good idea.
Right. Now, beyond these mental habits, the book also provides some practical advice for honing your skills. One technique they recommend is paper trading.
Paper trading, is that like making origami swans out of stock certificates?
Not quite. It's basically practicing your strategies in a simulated environment before you risk any real money. It's like a flight simulator for investors.
So you can make all the mistakes you want without crashing and burning your actual portfolio. That sounds like a smart way to build confidence and get a feel for the market before diving in headfirst.
Exactly. And they also emphasize the importance of having a dedicated workspace for your investing activities. No trading from the couch or checking stock prices while you're supposed to be working on that big presentation.
So it's about creating a mental and physical space where you can focus and make rational decisions. Free from distractions, no Netflix, and chill while you're analyzing stock charts.
Right. Now let's talk about the tools of the trade. The authors go beyond theory and provide a list of essential resources for putting these strategies into action.
Like a treasure map leading to financial freedom. So what kind of resources are we talking about?
They recommend specific websites for financial research, charting software to track stock movements, and even tips for choosing the right online broker to execute your trades.
So they're equipping you with the whole toolkit, not just the instruction manual. Speaking of tools, they have a whole section on using technical analysis to spot trends and make more informed trading decisions. I've heard a lot about technical analysis, but it always seemed a bit mysterious.
It's essentially the art of studying charts and patterns to identify potential buy and sell signals. Think of it like reading the market's body language.
So instead of trying to predict the future, you're looking for clues in the past to guide your decisions.
Exactly. They explain basic concepts like support and resistance levels, which are essentially price zones where the stock has historically struggled to break through. Support is like a floor, resistance is like a ceiling, and the price tends to bounce between these levels.
Okay, so you're looking for patterns and historical trends to help you anticipate where the price might be headed.
Right. And they also emphasize the importance of understanding volume patterns. High trading volume often confirms the strength of a trend, whether it's upward or downward. It's like seeing a crowd rushing towards a store. You know something's going on.
So it's not just about the price movement, it's about the conviction behind it. More people buying or selling usually means a stronger signal.
Exactly. They also discuss the importance of using moving averages, which are essentially lines on a chart that smooth out price fluctuations and help you see the overall trend direction. Think of it like filtering out the noise and focusing on the bigger picture.
So it's like looking at a map instead of getting lost in the individual streets and alleys.
They even touch upon more advanced concepts like candlestick patterns, which provide visual cues about buying and selling pressure in the market.
Candlestick patterns, those sound kind of mystical. Do I need to consult a fortune teller to understand them?
Not at all. They're actually quite intuitive once you learn the basic formations. They can help you spot potential reversals, breakouts, and continuation patterns, giving you more insights for timing your trades.
Okay, so it's like learning a new language, but instead of words and grammar, it's charts and patterns.
And they provide a good foundation.
Mm.
But mastering these techniques definitely takes practice and further study.
Now, beyond the technical aspects, they also delve into the psychological side of trading, which is often overlooked. It's not just about having the right strategy. It's about having the right mindset to execute it right.
Absolutely. The book highlights common psychological pitfalls that can sabotage even the most well-thought-out plans.
Like what? Spill the tea. What kind of mental traps should we be aware of?
One of the biggest culprits is the fear of missing out, or FOMO, as it's known in the trading world, that feeling that everyone else is making money except you, which can lead to impulsive decisions and chasing those hot stocks that are already soaring.
Oh, yeah. FOMO is a powerful force. It's like seeing everyone else at a party having fun while you're stuck in the corner feeling left out.
And then there's the opposite problem, the tendency to hold on to losing trades for too long, hoping they'll magically turn around. It's like refusing to admit that you've backed the wrong horse in a race, even as it falls further and further behind.
So it's about knowing when to cut your losses and move on. Sometimes the best trade is the one you don't make.
They also talk about the dangers of overconfidence, especially after a string of wins. It's like thinking you're invincible after winning a few hands of poker, which can lead to taking bigger risks and ultimately bigger losses.
It's like that saying, pride comes before the fall. But they also talk about the positive side of psychology, right? Like the importance of confidence and self-belief.
Absolutely. They emphasize the importance of having a positive mindset, believing in your ability to learn and grow as an investor, and not letting those inevitable setbacks derail you from your goals.
So it's about finding that sweet spot between discipline and optimism, not getting too carried away by wins or too discouraged by losses.
Exactly. They also provide some practical tips for managing risk, which is crucial for any investor, regardless of their strategy.
Okay, risk management. That sounds important. What kind of advice do they offer?
They reiterate the importance of diversification, spreading your investments across different asset classes, sectors, and even geographical regions to reduce your exposure to any single risk.
So it's like that old saying, don't put all your eggs in one basket. If one basket falls, you still have others to cushion the blow.
They also talk about the importance of position sizing, which is essentially determining how much money to allocate to each individual trade.
So it's not just about what you buy, it's about how much you buy. You don't want to go all in on one stock and risk losing everything if it tanks.
Exactly. They provide some guidelines for position sizing based on your risk tolerance and overall portfolio size. They also re-emphasize the use of stop-loss orders, which automatically sell your position if the price drops below a certain level, limiting your potential losses.
So it's like having an insurance policy on your investments. Okay, so we've covered diversification, position sizing, stop-loss orders. Any other risk management tips?
Well, they also talk about the importance of staying informed, keeping up with market news and trends, and not just blindly following the headlines.
So it's about being a critical thinker, not just a passive consumer of financial news. But with so much information out there, how do you know what to pay attention to?
They recommend focusing on reliable sources of information, filtering out the noise, and developing your own analytical skills to evaluate the news and its potential impact on your investments.
So it's about becoming a savvy consumer of financial news, not just blindly following the herd.
Exactly. Now, before we move on, let's touch upon one more crucial concept they emphasize throughout the book: the importance of having a long-term perspective.
Okay, long-term thinking. That sounds like a good antidote to all the short-term noise and volatility in the market.
They encourage readers to focus on their long-term goals, whether it's retirement, financial independence, or funding your dream vacation home, and to ride out the inevitable market cycles without panicking.
So it's about having that big picture in mind, not getting swayed by every little dip or surge in the market.
And they remind us of the power of compounding, which works best over time. The longer you stay invested, the more that snowball effect of earning returns on your returns kicks in, allowing your wealth to grow exponentially.
So patience is truly a virtue in investing. The earlier you start and the longer you stay invested, the better. Now, before we wrap up this part, let's talk about the practical side of getting started. They have a whole section on choosing the right online broker, right? I'm feeling overwhelmed just thinking about all the choices out there.
They simplify the process by providing a checklist of factors to consider when selecting an online broker.
Okay, give me the cheat sheet. What are the most important things to look for?
They emphasize security and reliability. You want to make sure your money is safe and that the platform won't crash when you're trying to make a trade. They also recommend looking for competitive trading fees, because those can eat into your profits over time.
So it's like finding a good mechanic for your car. You want someone who's trustworthy, reliable, and won't overcharge you for their services.
They also discuss the different types of accounts available, such as cash accounts and margin accounts.
Hold on, margin accounts, those are the ones where you can borrow money to amplify your returns, right? But they also come with higher risk, if I remember correctly.
Exactly. They explain the pros and cons of each type of account and recommend choosing one that aligns with your risk tolerance and investment goals.
So it's about knowing your limits and not biting off more than you can chew.
They also provide tips for setting up your trading platform, customizing charts, and using technical indicators to track your investments.
So it's like setting up your command center for financial success. But once you've got everything set up and you're making those trades, they also emphasize the importance of record keeping, right?
Absolutely. They recommend keeping a trading journal, documenting your entry and exit points, your rationale for each trade, and the lessons learned from both your wins and losses.
So it's like having a personal trainer for your investments, helping you track your progress, identify weaknesses, and refine your strategies over time.
They also discuss the importance of having a mentor or a community of like-minded investors to support you on your journey.
That makes sense. Investing can feel pretty lonely sometimes, especially when you're first starting out. It's great to have someone to bounce ideas off of and learn from their experiences.
They suggest joining online forums, attending seminars, or even finding a mentor who can guide you along the way.
So it's about leveraging the power of community and shared knowledge. Investing doesn't have to be a solitary pursuit.
Exactly. And finally, they emphasize the importance of continuous learning, staying curious, and constantly expanding your knowledge of the markets and different investment strategies.
So it's not just about reading one book and calling it a day. It's about becoming a lifelong learner, always striving to improve your skills and adapt to the ever-changing dynamics of the market.
Right. This book provides a great foundation, but the real journey begins when you put these principles into practice and continue to learn and grow as an investor.
Before we wrap up this deep dive, I'd love to hear from you, our listener. What stood out to you as the most valuable takeaway from Secrets of Millionaire Investors? What action steps are you inspired to take? Let us know in the comments.
Welcome back to the final part of our deep dive into Secrets of Millionaire Investors. As we've been unpacking these strategies and insights, it's become clear that successful investing is like a multifaceted journey.
Totally. It's like we've been given a map with all these different routes to financial success, but the key is choosing the path that aligns with, like your personality, your goals, and your risk tolerance.
And they really drive home the point that no matter which path you choose, the journey requires patience, discipline, and a willingness to continuously learn and adapt.
It's not a get-rich-quick scheme. It's a long-term game where consistency and a solid mindset are just as important as, the technical know-how. Speaking of mindset, there's one concept they bring up that I found particularly intriguing: developing a contrarian mindset. What exactly do they mean by that?
It's about having the courage to go against the herd mentality, buying when others are fearful and selling when others are greedy.
So zigging when everyone else is zagging, but isn't that a recipe for disaster? What if the herd is right and you're the lone wolf heading in the wrong direction?
That's where your analysis and research come in. It's not about blindly doing the opposite of what everyone else is doing. It's about having the conviction to stand apart from the crowd when you know your own assessment of a situation differs from the prevailing sentiment.
So you're not just like blindly rebelling, you're making informed decisions based on your own research and judgment. They also emphasize the importance of having a clearly defined investment philosophy, right?
Exactly. It's about knowing your strengths, weaknesses, and risk tolerance. They encourage you to explore different approaches like value investing, growth investing, and momentum investing, and to find the style that resonates most with your personality and goals.
So it's like finding your own investing groove, the rhythm that feels right for you. And they also stress the importance of having realistic expectations, right? Not expecting to turn $1,000 into $1 million overnight or become the next Warren Buffett in a year.
Absolutely. They caution against chasing quick profits or falling for those get-rich-quick schemes that often lead to disappointment and losses. Instead, they emphasize the importance of focusing on slow and steady growth, making informed decisions, and staying committed to your long-term goals.
It's like building a house brick by brick rather than trying to construct a skyscraper overnight. And they wrap up with some practical advice for managing your portfolio, right?
Yes, they recommend rebalancing your portfolio periodically to ensure your asset allocation still aligns with your risk tolerance and goals. They also emphasize the importance of living within your means, saving consistently, and avoiding unnecessary debt.
So it's about having a holistic approach to your finances, not just focusing on your investments in isolation. Your spending habits, your savings rate, and your investment strategy all work together.
Precisely. Now, as we wrap up this deep dive, I want to leave you with a thought that resonates throughout the book. Anyone can become a successful investor. It's not about having a high IQ or being a financial whiz. It's about developing the right mindset, honing your skills, staying committed to the process, and embracing the journey.
That's a great note to end on. Secrets of Millionaire Investors has provided us with valuable insights and practical tools to navigate this exciting world of investing. Remember, the journey to financial freedom starts with a single step. So go forth, make informed decisions, and may your investments grow wisely and steadily. Thanks for joining us on the Deep Dive.